think that the key issue that markets and companies have got to process at the moment is how bad inflation is going to be, and perhaps more importantly, how much damage to economies central banks are going to do in order to bring inflation under control. So central banks are indicating that GDP growth is of secondary importance to bringing inflation back under control, and that means that they're prepared to raise rates aggressively if necessary to bring inflation back under control. Now, given that that's the case, it's really important that in portfolios you have companies that are relatively insulated from a very poor GDP growth environment, because it's important to remember that interest rates have already been increased. They seem likely to continue to be increased, but the effects of interest rate increases will not be felt for around 18 months from when those interest rates started. So the effects on the real economy are only going to be felt during next year. What we're seeing at the moment is nothing compared to the impact that we're going to see on GDP growth during 2023. This has been a difficult environment for markets, as markets are pricing in a more difficult economic outlook. And in this environment, it's not surprising to see defensive companies that we have in the portfolio, generally speaking, doing pretty well. So for example, United Health has been among our top performers because it's a health insurance provider, but it's also rolling out a new data subsidiary across the US, providing value-added information to US healthcare providers and insurance providers. And that's simply a matter of executing a rollout there. Another company which has done well is Colgate Palmolive. Colgate Palmolive didn't have such a good first quarter, but of course its naturally defensive characteristics are now driving investors to move towards that stock, and the stock has been up strongly in the second quarter of 2022. And finally, Nordisk, which is another healthcare company well known for providing treatments and solutions for people who suffer from diabetes, but the company is also rolling out an anti-obesity drug that has proven to be really effective. It's a weekly injection, it suppresses your appetite, it's called Wegovy, and it's selling extremely strongly, and so the company is generally speaking surprising on the upside when it announces its results. So those are three that have been doing well. In terms of companies that have been doing less well in recent times, Illumina is a company which provides DNA sequencing and testing equipment. That's not done so well because it's announced a big acquisition of a company that it may now be forced to sell by the European competition authorities, and the markets haven't responded well to that information. Booking Holdings has not been doing well in the short term because of a lot of headlines about travel chaos and also rising fuel prices potentially impacting travel volumes. And finally, Alphabet's been announcing results a little bit below expectations, pointing to weaker brand advertising. Brand advertising is the first thing that companies cut back on when they expect trouble. Yes, we do an enormous amount of research into the future environment for the companies that we've invested in, because we're planning to stay invested in them for 5 to 10 years at a time. And we have a process called Dora Days in which we take time out of stock research and do research into the long-term secular trends of the future. One of the most interesting areas that we've been researching in recent times is how supply chains are going to evolve, because the old model of basing production of a product in a low-cost environment in a country which may be many, many miles away from the consumer, and then shipping the product to the consumer perhaps thousands of miles across the sea, is vulnerable. It's vulnerable to supply chain interruptions. Therefore, the next moves in supply chains are likely to be to move productive capacity closer to the consumer. That's going to mean building new factories, new productive capacity in the consumer markets or close to the consumer markets, a process sometimes called onshoring or nearshoring or even friendshoring. What's interesting about this is that the new productive capacity, when it comes online, is going to need to be very highly automated. It's going to have to maintain a cost advantage. And that means you're going to need robotics, etc., in those factories to make them efficient and to make them competitive. And that means that the outlook for industrial automation companies, such as the two industrial automation companies that we have in the portfolio, Fanuc and Keyence, is likely to be very strong on a long-term basis from here. And that's a trend that we think is a positive for the portfolio in future.